Hi everyone, this is Ankur Shah from the Value Investing India Report, and today we're here with Rahul Saraogi, Managing Director of Atyant Capital, who's actually releasing a new book coming out. And we have a great opportunity just to ask him a few questions. And the name of the book is Investing in India, A Value Investor's Guide to the Biggest Untapped Opportunity in the World. Hi Rahul, thank you for joining us. And I guess it's interesting, I read the first chapter of the book, and it's clear that India is a challenging market for both domestic and, I think, foreign investors. I think, what are some of the most common pitfalls you found for investors investing in India?
Ankur, as I mentioned in my book, I've spent a bit of time in the first chapter talking about the Indian family system, where Indian families are coming from, where Indian individuals are coming from. There was a while, maybe 30 years ago when the Japanese were doing very well compared to the Americans, and, the US economy had all kinds of inflation issues, etc. There was this East versus West philosophy that sort of took off and, became part of popular culture. It sort of died out, in the last 15 years or so, 20 years or so. When we take a look at India, so much of what Indian managements and so much of what Indian promoters and entrepreneurs and business people do are driven by family considerations. And the considerations of their families are really driven from culture, and it's from where they are coming from. The basic idea that I talk about, the joint family system, saving for 7 generations, the affinity for land, how nepotism and dynasty is an accepted part of culture. All of these things make a very big impact in how companies are run, how companies are managed, and you see them manifesting themselves in multiple ways, almost every day. I mean, if you take Narayan Murthy coming back to Infosys and hiring Rohan Murthy as his executive assistant, the paranoia surrounding, who's going to be the next CEO of Infosys, I think the paranoia is coming from this idea that it's not outlandish if Narayan Murthy were to nominate Rohan Murthy to be the CEO. I mean, it's happened in companies across the country. The fact that such a thing could happen at Infosys is possible. So that's where, that's what I'm trying to sensitize the reader to.
So I guess, is a large part of your investment process focused on the management team itself and trying to understand transitions as they occur or if they're going to happen?
Once again, I'll go back to the book. So I've spent a chapter, which is the 5th chapter, about value investing in India. We've learned from all the investment greats. So, the Ben Grahams, the Phil Fishers, the Warren Buffetts of the world. We understand that we now understand how to look at moats, how to look at financial strength, how to look at return on capital, and so on and so forth. The difference, I would say, in my investment process is I had 2 filters before I start analyzing the business and the financials of a company. And those 2 filters are related to governance and capital allocation. So I would not say that investing in India is any different or my process is any different. But I think looking at the management and looking at the owners and looking at their aspirations and their ethos and ethics is a precursor to getting into the business itself.
Right. Okay. Great. It's interesting. I think some of the bloom has come off the BRIC story somewhat. So why did you consider India the biggest untapped opportunity globally?
Charlie Munger has explained that the market is a pari-mutual betting system. So, it's not important, the correlation, for example, between GDP growth and investment returns is very, very poor. So it's not important how fast an economy is growing or, etc. for investment returns. What's important is, how it's being priced, how it's being understood. And in that context, so when I'm making a statement of the biggest untapped opportunity, what the case that I'm trying to make is that sentiment is terrible. People just haven't put in the time and effort needed to understand India and the opportunities that it presents. It's not going to remain untapped forever. At some point, there will be a mania about India and about all things India. But as things stand today, I think that nobody is allocating any resources, any mental bandwidth to understanding India, and in that sense, it's untapped. And the reason I believe its value is because this is something that I touch upon in the book. Is it's a 5,000-year-old trading civilization. It is recorded history of 5,000 years. Business people, entrepreneurs know how to make money from money. Capital is understood. Return on capital is understood. So that's a value investor's paradise.
Right. Exactly. Are you seeing any kind of increase in popularity with foreign investors, especially institutional investors? Or has it kind of been steady state for the past few years?
So I mean, the last 2 years were really bad for India. I think 2012 and 2013, in terms of sentiment, I think sentiment towards India probably, hit a low when the rupee went to 68 or 69 versus the dollar just before Rajan came in. I think since then, and since the rupee bottomed out, and part one of the taper crisis was done, we've seen some improvement, but I think that it's very, very early days. People have at least started looking up and noticing. I don't see anybody putting any meaningful resources on the ground yet.
That's interesting. So I guess you talk about some of the trends impacting India, one of them being urbanization, and also just kind of the rise of the middle class. Are there any specific trends you're looking at, or companies that are benefiting disproportionately from those trends?
So I don't know if I want to touch upon specific trends for investment today, but I can talk about India itself. It's a very large country, 1.2 billion people, and the demographics everybody knows is 50% is under the age of 30 or under the age of 25, and it's going to drive consumption. It's going to drive urbanization. There's going to be infrastructure built out. It's going to drive financial services. So I think the trend is that everything in India is going to grow. In my view, one of the things that we're going to see in India over the next 10 years is we've climbed a very steep learning curve over the last 15 years with respect to things like infrastructure, things like hydrocarbon exploration, things like public-private partnership, what we want to do with energy pricing, what we want to do with power pricing, what we want to do with open access. So let me give you an example. The Electricity Act came out in 2003. And the Electricity Act separated power generation from power transmission and distribution, and let's say from city point of sale. So it divided it into three things. A lot of mistakes were made. A lot of states went out and signed. So I know of a case in Tamil Nadu, the state where I live, where the Tamil Nadu Electricity Board went and signed a power purchase agreement for 20 cents per kilowatt hour, 12 rupees per kilowatt hour for a power plant based on fuel oil. I mean, that's clearly a mistake in hindsight. So things like that. And then the extreme overreaction to that has been that the Electricity Board just does not sign any power purchase agreements now. If you take a look at the sector, if you take a look at what's happening with fuel pricing, if you take a look at roads, if you take a look at airports, if you take a look at any of these areas, I think that the last 15 years we've climbed a very, very big learning curve. And I think the benefits of that are going to accrue over the next 10 years. The hydrocarbon sector, NEL first came out in 1999. We had the Ambani dispute. I've touched upon that in the book. The Director General of Hydrocarbons has learned a lot. So I think that India is going to be a large oil and gas producer over the next 15 years. So I see a lot of opportunity everywhere I look in India.
That's interesting. That's great. How do you approach valuation? I mean, you mentioned a little bit kind of the traditional valuation metrics. Is there any particular way you approach Indian companies as opposed to a U.S. or European company?
In that sense, my personal approach is a little bit more orthodox. So, what I look for is asymmetry. And by asymmetry, so asymmetry is just a cousin of margin of safety, right? So margin of safety is you buy at a price where you have a deep enough margin so that if you've made a mistake, you don't lose money. Well, it's not just enough that you don't lose money, it's also important that you potentially make money. So the asymmetry is, how much do I lose if I'm wrong and how much do I make if I'm right? And asymmetry is usually a very good guidepost to valuations as well. So if you take a look at as a stock, as a piece of a business, and then you take a look at, this is my investment thesis about this business. If I was wrong, what could I lose? And if I was right, where could I go? That will give you a pretty good sense of where valuations are. I think that's a much better way to approach it than to say, hey, price to book value should be less than 1, or PE should be 15 or something like that.
Right. So if you look at the market, we're basically hitting all-time highs. How are you seeing valuations across sectors or individual companies? Are you finding things pretty expensive and hard to find new ideas?
I've always looked at the market as a market of stocks rather than a stock market. I mean, that's been my approach for the last 15 years. So it's bottom-up individual companies. My answer is there's plenty to do. I'm sure there are pockets that are overpriced that are probably not on our radar, but we're pretty busy. I mean, we have our hands full. So I think there's a lot of opportunity in the market.
Great. And when you look for new ideas, can you talk a little bit about your process? Is it mostly just bottoms-up research? Do you talk to other investors? Do you have a screening process that you might use?
So what I have is I have a funnel approach, and when you're doing idea generation, my goal is to get as many companies into the funnel as possible. So if it is by talking to somebody, if you're going to give me a stock idea right now, it will probably go into my funnel and I'll probably take a look at it. So at the idea generation stage, you want to keep an open mind. Things could come on your radar because of policy, things could come on your radar because of something happening in the world, because it showed up on a stock screener, because a friend told you about it, who you trust. And once the names come into the funnel, then I sort of run it through the filters that I talk about in the book, which is corporate governance, capital allocation, how strong is the business, how strong are the financials, and then how the stock or the company fits relative to the other opportunities that I have on my plate. Now, unfortunately, none of these 5 filters is a quantitative filter that can give you an answer to the third decimal point. They're subjective filters, and it's all shades of gray. So, I talk about in my book, and I guess I pose more questions than I answer. Is corporate governance, right? I mean, at what point do you say this is acceptable and this is not acceptable? It's just something out of practice and experience.
Are you seeing a trend towards better corporate governance, at least, now that just more interest from foreign institutional investors or more pressure from domestic investors?
So, I actually attended a conference in 2005 where one of the speakers was Mr. Uday Kotak. And, one of the comments he made in 2005 was that we've seen such an improvement in standards of corporate governance, right? And then obviously, as the last 6-7 years would tell you that we've probably given away all of that. There are two parts to corporate governance, in my opinion. One is apparent corporate governance, and one is real corporate governance. When you talk about apparent corporate governance, if you start valuing companies at 25 times earnings, at 30 times earnings, and if everyone's stomach is full, including promoters and owners and entrepreneurs, yeah, obviously you're not going to see the governance violations. It's against their interest to have governance violations. So I call that apparent corporate governance. Real corporate governance is when there is a mindset change, when the people running and managing the business truly believe that there is, Benjamin Franklin said honesty is the best policy. He didn't say honesty is morally right or whatever. So when entrepreneurs and management start to think that right governance is the right policy for various reasons, that is what I call an improvement in governance. So in that sense, you know, I'm seeing more and more people starting to convert to better governance, which I think is encouraging for India.
Yeah, from my perspective, I think the only way to really address corporate governance from an individual investor perspective, or at least from a minority shareholder perspective, is to either just sell your position or not get involved. But at least in the West, you have a lot of activism. Are there any trends towards more activism, at least on the Indian side, from your perspective?
I mean, we've seen recent cases, right? We saw mutual funds going after Suzuki, and then Maruti making some changes, and then we had the case of TCI, which I've mentioned in the book. I can share my personal opinion on that. Is I think, when you approach governance, approach governance as a philosophy behind the management and not as a particular action. It's very hard to change someone's governance philosophy by being activist against them. So, yes, you could make them change a particular poor governance transaction, but that doesn't make them a good partner because the potential for future violations does exist. So in that sense, I'm not a very big fan of activism because, I don't think that we can change managements meaningfully. So I agree with you. As minority shareholders, our biggest weapon or our option is to not play ball with managements and promoters that don't get it.
Given kind of the changes going on from both a government perspective and policy perspective, how do you approach your holding periods, and do you modify it to any degree as you're investing in India?
So, first, my goal with investing is to compound capital at a high rate without losing money. So it's a simple goal, right? There are two ways in which capital is compounded, obviously. One is when the underlying company is compounding your capital, and the second is when the market recognizes that the underlying company is compounding your capital, and you actually see it in the movement of your stock on a mark-to-market basis. I'm happy holding a stock which is compounding its capital on a real basis, even if it does not see that recognized on the stock exchanges for a very long period of time. So I've held companies for 7-8 years in the current context, which have probably doubled their book value and their intrinsic value every 3 years, because they're compounding at 25%, and their valuation in the market just keeps falling. So from 1.5 times book, they're probably now down to 0.3 times book, just because the value keeps compounding. So I'm okay with that. I mean, because at some point the market becomes a weighing machine and not a voting machine.
Sure, exactly. At some point that value should be realized.
Yeah.
Great. Thanks for your time. When is the book coming out?
I believe the book is out. I have my copy, so I believe the book is out in stores already. Unfortunately, it's out only in the US at this time, and then Wiley is going to take a call on when they send it to the other markets. But I think the ebook version should be out as well soon.
Okay, great. So, and it's available at Wiley's website and also on Amazon, is that correct?
Yeah, so it's on Wiley's website, and then they point you in the direction of various other places where you can get it.
Okay, great. Thanks, I appreciate your time, and look forward to reading the book.
Yeah, good talking to you, Ankur. Take care.
Thanks, Rahul.